Hello and welcome to this video on return on capital employed. So in this video we're going to look at the calculation and the concept of return on capital employed and also how we interpret the results. So let's start off with what this means. Return on capital employed, or ROCE for short, measures how much profit, the return, is made by a business compared to how much capital has been invested in the business, or capital employed. So when we think about the capital that's invested in the business, all the money that's been used to provide or to buy assets that the business uses has either come from loans or it's come from shareholders through money they've invested or through money that has been retained profit that's been kept within the business. So by capital employed we mean the non-current liabilities and the total equity. And this money has been used to buy stock, to buy lorries, machinery, factories. It's been invested in assets. And then what we want to do is, well, how well has this been invested? That's what we want to measure. So we're going to look at the profit, the return we're getting from the business, which will give us an indication of how well this money has been invested in assets. So here is an example of different divisions within a business or some well-known companies, and we can see here's the annual operating profit and here is the capital employed, and what we're looking at calculating is the profit we're getting back as a proportion of the amount of money that's been invested in assets to provide to operate the business. And we can see here the return on capital employed for Costa UK coffee bars, 46.3%, is much higher than for Mandarin Oriental hotels, only 7.9%. So we calculate the return on capital employed by using the following formula. We take the operating profit, the profit from the business itself, from the business activities, divide by the capital employed, and then we times by 100. A reminder that the capital employed is the non-current liabilities plus the total equity. So we need to look at both the statement of financial position and the statement of comprehensive income to perform this ratio. Although the return can vary between industries, and we should always be looking at making comparisons between firms within the same industry, the higher the percentage figure, generally speaking, the better. How can we improve our return on capital employed if we get a low answer? Well, we can try and increase operating profit, take some measure to increase profit, or if we were to repay some existing long-term loans, this would reduce capital employed. We should be comparing this figure with the return on capital employed from in previous years, return on capital employed of competitors in the same industry, or maybe the current base rate of interest. Rather than investing our money in this business, we could always just invested our money in the bank and earned a particular rate of interest. So let's have a quick maths moment here. We have a statement of financial position on the left hand side and a statement of comprehensive income, and the question might be, well, how would we measure how well the assets are being used within this particular business? We would go for our ratio, the return on capital employed, and we would write down our formula, operating profit divided by capital employed times 100. Now let's start off with the operating profit. That's the easy bit. We look at our statement of comprehensive income and we go down to operating profit, and we know that that's 4.58 billion. Now our capital employed is a non-current liabilities, so 6,000, and our total equity, and the total equity here 11,235 million, so 11.2 billion, and that's the 6,000 of share capital and the 5,235 of retained profit. So this would be our calculation, remembering here that the non-current liabilities are not a negative number for this purpose. It's money that has been used within the business. So 6,000 and 11,235, 17,235 is the capital employed. Operating profit divided by capital employed times 100. The return on capital employed for this business will be 27%, which is telling us for every £1 of money that's been invested in the business, capital employed, we're generating 27 pence in operating profit. So we can use this to compare how well money is being invested between two businesses. So you might want to pause the video here and have a go at calculating the return on capital for company X and company Y and making a comparison. Well, the return on capital for company X is 22.8%, and we did that by taking operating profit and dividing by the equity plus the non-current liabilities. For company Y, it's 18.7%, and we did the same formula. So on this basis, we would say that company X is using the capital employed within the business more effectively to generate profit than company Y. So return on capital employed can be used by a business to help make decisions. It can maybe linked to the manager's financial rewards. If we achieve a certain return on capital, then this might have an impact on your bonus or some performance related pay. If we have a certain target to use our money efficiently within the business, we might be able to generate some needs perhaps for training of employees in order to use the assets within the business more efficiently. We can use it to assess future investments. We can use it to maybe decide whether to purchase new assets or get rid of existing assets. And we can also use it in conjunction or alongside capacity utilization targets. Generally speaking, the higher capacity utilization is going to improve our return on capital employed. So we mentioned there we could use it to make a comparison between projects, and we might want to say which is better, project A or project B. You might want to pause the video, do a quick calculation and see if you can come up with the answer. Well, project A is going to generate us returns of £1 million per year from an investment of 10 million, so it has a return on capital of 10%. Whereas project B, 3 million from a 35 million investment, will give us a return on capital of only 8.6%. So we would probably suggest project A on this basis, although there may be other factors which would go in project B's favour, more qualitative factors. So in this video we've looked at how we perform the calculation of return on capital employed, what it means, and how we interpret the result. That's it. Thank you very much for listening.